to be they were carefully evaluated by the bankers. If current assets are less than current liabilities, the entity of the working capital deficiencies are called working capital deficiencies. This involves managing the relationship of firms' short-term assets and short-term loans. Diversion of funds leads to liquidity crunch. So banks are giving only working capital means it is a short-term fund. If at all they have purchased land, diversion. If at all they invested in real estate, diversion of funds. So here, why the unit are turned into non-performing? Why the banks unable to recover? Most of the companies they are telling loss. No, diversions. So once the banks are given 100 crores for working capital, some working capital they will use, remaining working capital they diverted. So all these things, banks are also cash hold of the people because monthly visits are there in the bank. Unit visits, that is called unit visits. They will go, how much stocks are there, how much drawing power in the account. If a drawing power is 100 crores, stocks are only 50 crores, then some amount. If that is credit sales are there, no problem. If not there, diverted the amount to other purpose. So this involves managing the relationship between firms' short-term assets and short-term diversion funds leads to liquidity crunch. Current assets are go through the operating cycle, as I told earlier, that is raw material, all these things. This cycle generally completed in a short span, less than 1 year. Suppose the 3 months cycle is there. 3 months means again for 1 year, 4 cycles are there. And if at all 1 month means 12 cycles are there. So cash to cash, 1 month means 30 days. For 360 days, 1 year, 12 cycles. So this is simple to understand, not a complicated one. The goal of working capital management ensures the firm is able to continue its operation and that it has sufficient cash flow to satisfy maturing terms operational expenses. Working capital is a lifeline of the project. Today, most of the company accounts turning to bad is on account of working capital. Frauds are also happening. Reserve Bank of India, they have issued one circular also. In public sector bank, out of the frauds, particularly loans and advances of fraud, 51% of the loans are, the fraudulent loans are there on account of working capital loans. But in private sector, it is 32% like that. 32% like that. Why? Because they will take some precautionary measures when compared to the public sector bank, etc., etc. Banks are insisting the insurance policy for stocks. If at all they have given stocks, particularly the stocks, banks will insist the stock, particularly insurance policy. So insurance policy also authorities, whenever the bank is giving loan, they will go to the company where the stocks are stored and based on the store's ledger and stock ledger and average amount how much is there per annum, and accordingly they will insure. Banks are insisting for 110% of the stock, 110% of the loan or actual stock, whichever is higher. Suppose a bank has given 200, average stock is there, but a bank has given 100. 100 means 110 or 200, whichever is higher. That is the insurance policy. The insurance policy also, in insurance policy, hypothecation clause is there. Hypothecation clause. What is a hypothecation clause? Hypothecation, if at all any fire accident was happened, they will, insurance company will verify and pay the claim to the bank once the hypothecation clause is there. So if you, as an IP, you verify the insurance policies for stocks, for plant and machine, and if stocks are persisting or continuing, then during the CIRP, you have to insure the properties. If at all anything happened during the CIRP process, the IPs are held responsible for not renewing the insurance policy. If at all any theft or fire or burglary or happened, then IPs are responsible for that. Business entities submit a monthly stock statement. Once the banks are giving working capital loans, they have to submit a monthly stock statement for arriving the drawing power. So if 100 crores is a drawing power limit for the stocks, if at all they have submitted 80 crores stock, margin is 25%, deduct 25% margin, 60 crores is the drawing power. If they submitted 200 crores, 200 crores, deduct 25% margin. Example, margin is 25%. It differs from company to company or sector to sector, and MSME, the lower margins are there, 10% margin may be there. If the company submitted 200 crores raw material, less 25%, 50, 150. But what is the limit? 100 crores. They will give 100 crores only. So every month stock statement. Being an IP, if at all the company is defunct, when they have stopped the stock statements, that you have to know. When they submitted because the financial creditors daily is interacted with you because he is a COC member, committee of creditors member, you get the information. Whatever the information, first you get the information from the financial creditor. Because earlier, before a defunct of the company, the unit is handling by who? The financial creditor only. Whatever the balance sheet, whatever the cash budget, whatever the liquidity problem, all are supervised monthly by whether the company is working or not, all are supervised by none other than the financial creditor. Because from the day one onwards, up to the account turn into bad, after filing of the application, you are coming to the picture. Before that, the full picture known to the financial creditor. That's why the COC is the correct person to handle the COC is the members are financial creditors. Okay. Now, large scale advance monthly visit by the banks and monthly inspection reports. If you want to know when the funds are diverted or mismanaged or fraudulent transactions are happened, that reports already available. And stock and book dates audit, every year bank will conduct a stock and book dates audit if the loan exposure is more than 5 crores. If the loan amount is more than 5 crores, stock and book dates audit. Working capital loans are to be renewed yearly basis based on the performance limit to be enhanced or reduced, call up the advance based on the turnover, etc. So here what I told is some of the information is available within the bank. You need not search, you need not verify, you need not ask the financial manager, etc. The correct, the accurate information is available with the banks. The unit file. The unit file. So that's why this class is next 5 days class is about the banking, about the banking loan mechanism. Because from the day one onwards, we are handling the case. We are already handling the case. How he is utilized the funds, how he mismanaged, or how he diverted, and we are giving some notices, different notices, and every month unit inspection and insurance policies. So most of the viable or the vital data is available in the bankers. That too, it is not a secrecy. That is a financial creditor main objective is to recover or to resolve this issue. The sensitive information is also available with the committee of creditors. Anyhow, IBC prevail over other acts. You will get that information instantly from the bankers. While renewing the working capital loans, whether sales and purchases are routed through the account not to be verified by the or not to be verified by the bankers. Whenever the bankers working capital limit major loans are most of the companies they are availing two or three. One is working capital, second one is term loan, third one is bills discount. While reviewing the working capital, whether sales and purchases are routed through the account or not to be verified by the banks, then only they will renew. That's why in the loan account, the debit side is purchases. The credit side is sales. All sales are to be routed through the account. All purchases are to be paid through the account. So while reviewing whether all sales are not, some companies they don't bother about this one. They will open a current account in other banks and they routed that that information is also available with the bankers. So here the cross checking and verifying is also very easy. Sometimes banks may sanction excess drawings or ahead of temporary drawings. Suppose 100 crores are there, immediately he requires 5 crores. And depending upon the delegation of financial powers, bank will grant the temporary drawings up to 10%. 10% means 100 crores into 10%, 10 crores. But once the bank is given 10 crores, they will take additional documentation. And whatever the existing security is there, that will extend it to the 10 crores also. Like that, ad hoc limits. There is a difference between ad hoc limit and temporary drawings. Ad hoc limit is only for 3 months. Temporary drawings is only for 15 days or 1 month like that. Okay. Now I think you got some clarity about the working capital. So now it is 3:30. We will break for tea for 10 minutes. After that, we will continue the term loss topic. Is it okay for all, sir? Okay?
Yes, sir. Yes, sir.
Okay, sir. Okay, sir. Sir, now I'm starting the term loan product of the banks. I will describe about the term loan of the bank. Setting up the project, that is company, involves acquisition of fixed assets which facilitate process of the production. For a process of production, they require some machinery. At the same time, some shelter, that is a production department premises or administrative department premises like that. For all these things, banks are giving a loan. These loans, particularly, this is long-term loans because the company is not getting the particular amount instantly. Instantly, they don't get the repayment over a period of time. Once the company is continuing and the production is increasing, or a repayment will happen through surplus generated. Whatever the sales minus whatever the cost of production and other expenses are there, the remaining is the balance, that is surplus available. Out of the surplus, they will pay this amount. That is called term loan. Fixed assets are largely longer life and generally not meant for resale. They are required to be retained over a period of time to exploit the productive and potential. And for this, because that is a long span of time is there, and their life is also more. And if at all banks are instantly fixed the repayment of the term loan, company is unable to pay because every year, whatever the surplus generated, through surplus generated only, they are able to pay the loan amount, particularly in case of term loan. But working capital, once a manufacturer, they will sell and they repay the loan and they will take again amount and purchase the raw material. That is a continuous process. That's why the term of the working capital is 1 year, whereas the term of the term loan is it may be 5 years, it may be 10 years, it may be 15 years, it may be 20 years, and maximum period is also. Particularly, I'm talking about the particular housing loan. It is 30 years as per Reserve Bank of India guidelines. They are required to be retained over a period of time, exploit the productive potential. If the company is continuing the production, no interruption, definitely the loan will be recovered. Thus, investment in current assets resilience is short term, while investment in fixed assets is a long term nature. For long term nature, term loan, short term nature, working capital loan. It is realized through surplus generated. Just I told, surplus generated in the form of a net profit and a depreciation and a non-cash write-offs, if it any provisions, all these things they will take into consideration. Accordingly, the EMIs are installments, whether it is a monthly or quarterly or half yearly or yearly installments, they will finalize. But once working capital, once the production starts, bank will give the working capital. Immediately, once the goods are sold, they will repay. But in case of a term loan, bank will give after 1.5 years or 3 years. Once the production completed and the commercial production starts, then only the repayment will start. Repayment will not start on the day one of a 1 month after the disbursement date. Once the production, the installation, the commercial trial run, all these things are to be completed, then only they will give this one. And as it takes a long time for the fixed assets to pay themselves, the promoter should raise suitable long-term funds to finance the projects. So normally, this requires long-term funds. First, whatever the share capital is there, they will use. Sometimes the debentures, sometimes a bond, and sometimes bank loans also. For new industries, debenture and bonds, subscription may not happen because of the background of the promoters, all these things the promoters will see. That's why most of the companies, they will avail the term loans from the banking industry. Term loan sources, particularly owned capital and borrowed capital. The owned capital is share capital or retained earnings, that is profits. Either share capital may be equity or preference shares. Other than that, for construction of building, for acquiring the land or plant and machinery, they will always require long-term funds. That own capital is not suffice. They will borrow funds from the bank or public deposit or a term loan or deferred payment guarantees, DPGs or debentures like that. And in most of the cases, the companies fall on or depending on the banks for term loans. The aggregate amount of the finance raised by the financing a project is referred as a capital comprising of two components. Owned capital, share capital, borrowed capital is called the debentures, bonds, deposits, class of creditor. We are talking these people as a class of creditor. Term loan loans are from the financial institutions, etc. Earlier, particularly, I'm talking about long back. Banks are saying, giving loans for working capital and IDBI, not this IDBI, earlier IDBI, IFCI, Industrial Finance Corporation of India, and long-term institutions are there. They use it to finance term loans. Banks are giving only the working capital. Today, that is not the case. Banks are giving not only the working capital, but also term loans. Other sources of long-term funds are capital subsidy. Sometimes the government of India, if at all the company is established in backward districts, particularly still the northeastern states or Bihar or different backward states, if any industries are established, government will give subsidies also. That is called capital subsidy. The project coming in the notified backward areas, interest-free loans. Sometimes interest-free loans are also offered by the government instead of a subsidy. By offered by state government, similar schemes, International Finance Commission, the corporations or World Bank or Asian Development Banks, mega projects, importance of the project developing in the emerging countries. So for term sources, companies require funds. Sometimes the companies may borrow funds from other countries also. Particularly the international finance, big companies, not small companies, not MSME like that. World Bank schemes are also there. Particularly Philippines, that is Asian Development Bank, ADB, Asian Development Bank, that is located in Philippines. They're also given some soft loans, interest-free loans. Some companies which are giving good importance for the development of the countries. After considering the availability of a long-term source of funds, the promoter will decide total financial structure of the company based on the cost of capital, equity, bonds, debentures, deposits, etc. It will depend upon the financial leverage. What is the financial leverage? Owned capital versus borrowed capital. Owned capital versus borrowed capital. Owned capital means preferences and share capital or particularly undistributed profits, if any, and borrowed capital. That leverage also banks will see. The max is 1:4. 1 is own capital, 5 is the borrowed capital. If too much borrowed capital is there, that is dangerous because the owner's stake is less. Borrower's stake is the external debt is more. A few projects, particularly, there are a few projects can be financed entirely on a debt or equity. Debt or equity. Today, some industries preference will be given by the government for those the industries. Banks are all offering a higher debt instead of lower debt, and that financial leverage ratios are also they will suitably modify. If that industry or sector is giving a contribution for the development of the state, the divergence of a debt equity are brought into alignment by the concept of debt by equity, that is called the gearing ratio, and determines the level of debt that can be supported with the quantum of equity. Banks always thinking about when they are giving any term loans, they will calculate a debt equity ratio and the debtors the debtors service coverage, DSCR, debtors service coverage ratio. Because how much after commercial production, how much income is generated, how much debt obligations are there, whether this surplus is suitable to repay the installments of the debt or not. For this purpose, debt means funded debt including term liabilities. Equity will include share capital and retained income. Standard debt equity ratio depends upon the capital gearing ratio. It depends upon the capital, that is a standard debt equity ratio. Amount invested in the project recovered through annual cash flows over the period of time. So whenever the banks are sanctioning the term loans, they don't give in a bulk or bullet amount based on the construction. Suppose I take for example, one building is there, ground floor. Once the ground floor is completed, up to that, whatever amount required, because that in the project report, all these things are specified. Even production department also, first let them complete the production department. After that, only final the machinery will, finance will happen. So financial plan, promoter will examine all attractiveness of the project, alternative source of investment. Normally, some of the promoters, they will search not only from the banks, from other sources also with a lower rate of interest. The process assists the management such a task collectively known as capital investment evaluation. Most of the once particularly the loans are given, term loans are given, banks will calculate either payback period or average rate of return method or net present value method or internal rate of return method for capital expenditure. This is a capital expenditure. Purchasing of a machinery or a construction of a building or construction of a factory premises, all are the capital investment. So for that, to arrive a conclusion, whether to give or not to give, based on the project report submitted by the borrower, they will calculate either payback period or average rate of return method or net present value method or internal rate of return method, or and whatever the debt equity ratio and the debt service coverage ratio, all these things are to be. The last one is called internal rate of return. What is the internal rate of return? The project is giving a return of 20%, and the bank rate of interest is 12%. Return is 20%, bank is 12%, 8% surplus is there. 8% surplus is there. If the banks are getting, if the loan, the return is 12%, bank is charging 13%, there is no use. The return on the project, that is internal rate of return of the project, after starting the production, the company is getting only 12% return. But the rate of interest to borrow the funds from the banks or others is 12, the 13%. There is no use. In that case, banks will reject the proposal. So net present value. What is the net present value method? Today, bank is giving loan. Returns are generated after 1 year or 2 year or 3 year or 4 year or 10 years, like that. All returns are to be brought down to the present value. If based on the discounted rate, that is rate of interest. Suppose I have received 100 rupees after 1 year. If a 10% rate of interest is there, the present value is 90 rupees. After 2 years, like that, all present values and future, the present cash outflow and the inflows of the future will be compared. Any surplus is there or not, they will verify. That is called a net present value method. And the payback period means once the bank is given loan, and how many years it will take to repay the loan through cash surplus generated through its operations. That is called payback period. And the rate of return means whatever the rate of returns monthly, whatever the surplus they are getting or yearly they are getting, All these things are to be average. That is called average rate of return. The above methods are called capital budgeting techniques. The above methods are used for while sanctioning the term loans to the corporate data. The object of the payback will find the time period required for recovering the entire amount of the investment in the project. Cash flows, net profit plus depreciation plus other non-cash write-offs ought to be compared and outlay of the project payback. It is a total investment, whatever the loan is given by the banks, divided by how much surplus is generated, that is cash flow per annum, number of years to recover the loan from the company. That is called a payback period. Average rate of return, generated life of the company, and the rate is calculated aggregating cash flows, dividing by the number of years investment expected to lost. This is also calculation purpose. All these things in the proposal, it is available. Net present value, just now I told, every year the company is generated some amount. Today I have disbursed 1 lakh. And the company is told that next 10 years I will pay this much amount. Next 10 years, how much surplus they are getting? That surplus to be valued present value. And the total present outlay is 1 lakh. What is the inflow? If inflow present value is more than the outflow, then the project is to be accepted. Otherwise, the project is to be rejected. Just I told about the internal rate of return method. Internal rate of return method is also one of the important method while sanctioning the term loan. On the project, if the return is 20% and the borrowed funds cost is 12%, that is the difference is 8% is net return after availing the loan. If 13% rate of interest is there, the return on that particular project is 12%. That is not correct. That type of banks are not giving loans for those projects. This is called the internal rate of return formula also I have given. Types of term assistance. Banks are giving term loans. What type of loans banks are giving? What type of loans banks are giving? The banks are giving particularly term loans. Term loans may be the in forex also banks are giving term loans, foreign exchange, or deferred payment guarantee. What is meant by deferred payment guarantee? Term loans, various types of term loans I am giving. Deferred payment guarantee. What is a deferred payment guarantee? DPG. Suppose banks are not interested to give the loan on imported goods. The exporter of other country, okay, I will give the loan for the machinery. And if any bank is giving a guarantee for the yearly installment, suppose a foreign country, they are importing one machinery, that is 1 lakh. That 1 lakh to be repaid in 10 installments. 10,000, 10,000, 10,000, 10,000. 10 months. If 10 months are there, then the exporter who is providing this machinery, first they will ask, if any bank is giving guarantee, then only I will provide the machinery to you. Every month, the importer who imports the machinery from the other country, he has to pay 10,000, 10,000. For each 10,000, bank will give one guarantee that is called a deferred payment guarantee. As long as the corporate debtor is paying the installment, there is no obligation from the bank side. Once he is defaulted, from there, the bank will pay the amount to the exporter based on the DPG guarantee. Deferred payment guarantee is also there. And best discounting scheme. Banks are also bills discounting. They will also give the discounting. That also I will discuss. Underwriting of shares and debentures. Sometimes the share capital. If at all they go for IPO, initial public offer, or follow on public offer, FPO, then if it is not subscribed fully, the balance the banks are ready to take, that is called underwriting facility. For that, they will charge some commission. For that, also banks are giving some facility and the letters of credit or bank guarantee and a credit delivery. Sir, here the credit delivery means the loans may be provided by one bank or multiple banks. Loans are provided by single bank or multiple banks. If a single bank is provided, there is no problem. Multiple banks are provided, that is called consortium lending. That is called consortium. So whoever provides highest amount, normally they will act as a consortium leader. And one tripartite agreement is also there. And among banks and borrower and the consortium leader. The amount is routed through the consortium leader only. The recovery will also received by the consortium leader, and the recovery will be distributed to all the banks as per their ratio. This is called consortium lending. And sometimes some banks, they are arranging syndication loans also. Syndication loans is another version of lending. In that lending, one bank, they will arrange whatever the credit facilities that are required. He is acted as a syndicator, and every bank different documentation, different this one is there. So this is called syndication of loans. For the arranging the loans by the bank from other banks, they will charge some commission also. This is more prevalent in developed countries. It is also there in India also. That is called syndication loans. A term loan is granted for a fixed term, not less than 1 year. If less than 1 year means it is as good as a working capital. Intended to finance fixed assets to be acquired carrying interest at a specified marginal cost lending rate or different types of lending rates are there for repayment. Here also the term loans either may be short or medium or long term, up to 3 years or up to 5 years short term, up to 10 years medium, thereafter long term. It depends upon the bank credit policy they will define. Deferred payment, as I told earlier, it is a contract to pay the suppliers of the price machinery supplied by him deferred terms. It is installment, in agreed installment with a stipulated interest on respective due dates. If a default in payment is there to the buyer by the buyer to the supplier, then bank role will come into the picture. Bank is given DPG guarantee, that's why their role is come into the picture. A DPG is in many respects a substitute of term loan. It is as good as a term loan, but bank may not have the funds. That's why they have not given the total amount, but they have given guarantee. That is called a deferred payment guarantee. And as far as buyer of the particular plant and machinery is concerned, it serves the term loan purpose only. Standard appraisal are the same for term loan. Whatever the term loan appraisal banks are doing for normal term loan proposal, the same term loan proposal is applicable for deferred payment guarantee also. Most of the banks term loans they are giving, particularly acquiring plant and machinery. This is the main area. Once the banks are giving a loan for term extents, the amount will be paid directly to the supplier. Particularly for electricity projects, whatever the diesel generator sets are there, once they get the quotation, the amount will be paid to the supplier to deliver the plant and machinery to the buyer, the borrower or corporate debtor. based on some undertaking taken from the corporator. Modernization of industry. Sometimes the banks will give term loans for modernization of. It is outdated or redundant, and the products are not up to the quality on account of the manual process, and they want to automate it. For that also, banks are giving modernization loans. Construction of buildings. Banks are giving loans, term loans for construction of buildings, whether it is an administrative or office buildings, or residential buildings of the staff, or the production department, or the lab, etc., etc. For a construction production department, for construction of a storage also. So these companies, sometimes they require the storage facilities, particularly to store the stocks. And for that also banks are giving loans and importing plant and machinery, etc., etc. For all these things, banks are giving term loan facilities. Now, I have covered the working capital and term loans. I have covered the working capital and term loans. What is the purpose of working capital? For acquiring raw material, and sometimes the block, they particularly the raw material ought to be preserved in the stock, the stores. Either it may be the raw material or maybe the work in progress in the production department or finished goods in the stores. Immediately, once the product is the manufactured, it is not possible to sell immediately in the market. That problem is also there. So for that, not only they further banks are giving working capital. Working capital not only for stocks, debtors also. Banks are giving credit to the debtors, that is called accounts receivables. That is called debtors. Some people, they will give bill of exchange. Once the credit sales are given bill of exchange, it is called accounts receivables. Without bills, it is called debtors. And for these two, banks are giving loans under working capital loans. Once the working capital loans are given by the bank, they will take the loan and they will take a security. Here also security, two types are there: primary security and secondary security. Primary security means whatever the assets are financed by the bank. In case of stock is a asset, that is primary security. And whatever the secondary security, it is called ancillary security. Ancillary security is nothing but additional security. Even though primary security is there, when he will manufacture, when he will sell in the market, whether he is pay the amount to bank or not, that is all our question marks only. For that, the banks are taking the collateral security. That is additional security, either way of land and buildings, or sometimes a plant and machinery, if at all it is not financed by any others. And sometimes present days, the banks are also, whatever the loans given by to the corporates, they will obtain guarantee, deed of guarantee from the company directors to strengthen the security. So once the loan is not recovered or less recovery is there, the balance is to be recovered from the directors also. This is various types of security. For term loans, normally whatever the assets, if the building is constructed with bank funds, building is the primary security. Normally in term loans, we don't insist any additional security, because here, if a bank is giving 100 rupees, 25% borrower's margin, 75% bank loan. Land is there, building constructed thereon. Every year the land will be appreciated. Okay, the building due to wear and tear, the building value may be decreased. But overall, the loan component will be covered, the building. And plant and machinery also. And plant and machinery normally we will take the collateral security because the obsolescence rate is more in the plant and machinery. Okay, this is with regard to term loans. And stock, whenever a bank are giving loans against a stock, they will take hypothecation agreement. Whenever they are giving a loan against the debtors assignment, whenever they are giving loans against building or plantation, mortgage documents, mortgage document. So these are the various documents that they will take. For all documents, Limitation Act will cover. That is a section 18 and 19 also. So this is in brief about the working capital and a term loan. Any doubts are there, sir? Any doubts? Sir, if no doubts, I will continue. Non-fund based business. Fund means the bank will give funds. For building, they will give funds. For stock, they will give funds. For debtors blockage, they will give funds. But sometimes some banks, they don't give any funds. Whatever the funds required, they will pay. Sometimes the companies are also not asking any funds. They require guarantee. Take for example, one reputed contractor is there. He is going to construct a road of 14 kilometers or 15 kilometers. 2 lines this side or 2 lines that side, or 4 lines this side or 4 lines that. He requires some amount, that is 50 crores or so. And he submitted the tender also. The tender is also, he got in his favor only. Immediately government of the particular state government, they ask some guarantee. If the road is not completed within the stipulated time, with the terms and conditions, you have to pay this much loss amount to the government. It may be 10 crores or 5 crores or 20, whatever the amount is there. Then borrowers, because he has to provide some, he has to purchase the raw material, labor, concrete or cement, whatever it is there, he has to contribute to construct that particular 15 kilometers road. But the government guarantee, if at all the government had also given chance either 20 crores to be deposited in government account or any public sector bank or private sector bank, whatever the bank is there, you give some guarantee. In case you have not completed the road, the compensation to be paid by the banks. This is called non-fund based business. Banks, they don't park the amount and they will give the guarantee. Whenever they are giving the guarantee, they will go through the history of the performance of the contract. Whether the contract is a grade is a good grade or not, how many contracts he has completed, how many he is completed stipulated time, any penalties imposed by the government or not. This is one example I am quoting. It may be the state or it may be the central or it may be the big projects, water dams, all whatever it is there. So the bank guarantees. That is for that banks are also issuing guarantees. And for that, whenever the bank guarantees are issued by the bank, only paper, that is guarantee form. The guarantee form taken from the bank and the guarantee taken from the bank and handed over to the government. Handed over to the government by the contractor. But banks don't give simply the guarantee form. For that also lot of appraisal. For that also the security norms are there. If he is not completed, then the bank obligation is in that earlier case 20 crores. So 20 crores worth of security bank will insist. And some relaxations and all these things are there. That is not required. But here 20 crores, if it is a not completed road, the bank obligation to pay to the government is 20 crores. For that, adequate security, either land or buildings that are owned by the particular contractor, they will take into consideration. That is called the guarantee. On guarantees, whenever the bank is giving guarantees, banks are charging commission, COMMISSION commission, on the guarantee amount. And sometimes, if at all he is an existing borrower, suppose I take for example, he is not an existing borrower to the bank, then some banks they may insist 100% fixed deposit to issue the bank guarantee. If at all 10 crores or guarantee is required, 10 crores you deposit, on the fixed deposit only we will issue the guarantee. But he is already existing borrower of the bank. He is availing some working capital limits and other term loans also. And a long relationship with the bank is there. Then the bank may consider 25% fixed deposit, 75% you give me any assets, either land or building like that. So this type of alternatives are also available. Need not be 100% fixed deposit. So in IBC also, whenever IP come across any guarantees, whether any collateral security given for the guarantee or not, that is to be verified. If at all it is a fixed deposit, that deposit also available with the bank. And if at all you are not aware of the guarantee details, then it is a problem. So once the contract is completed, immediately the borrower will go and the bank and they will ask to get the refund of that particular fixed deposit. So whenever you are occupying the seat of the CEO of the company, how many guarantees are there? The guarantees are whether it is a fully fixed deposit base, that is called 100% cash margin, or 25% cash margin and 75% collateral. That is also required. So here the banks, they are giving guarantees. Bank guarantees are, the companies are also, they will mention in the footnote of the balance sheet. The bank guarantees are not reflected in the balance sheet. It is a contingent liability. As long as the construction completed, they will get the refund amount also. Who? Particularly the corporate data will get the full amount. Once the construction is over, he will go to the bank, sir, completed. This is a government certificate, and whatever the deposit I have given for this guarantee, please credit to my current account like that. And once he completed, he is also existing borrower. Sir, for this guarantee, I have paid 25% cash margin and my personal properties are given. Give the properties and a fixed amount you credit to the company. So that's why being a insolvency professional, you have to look into the guarantees, how many guarantees are there. Normally, whether guarantee or a type of loan, from how many banks the particular corporate data are availed. If at all readily, instantly that book of accounts are not available, you get the CIBIL ratings. CIBIL scoring are two types. One is commercial civil, second one is individual civil. Commercial civil means company, individual means the directors. If you get the commercial and civil, the commercial as well as individual, you get the fair idea about that particular how many loans available by the company with the different banks. All are available at one particular this one, and ROC also. Because whenever any type of funding is given by the banks to the company, they will register with the ROC under Section 77 of the Companies Act 2013. So the non-fund based bank guarantees are a prominent one. And most of the construction companies, they are using bank guarantees widely, in addition to working capital and term loan also. And what is the letters of credit? Letters of credit. Any doubts, sir, on bank guarantee? Sir. Okay. Next, letters of credit. What is a letters of credit? Letters of credit means some of the companies, they require imported goods, either plant and machinery or stocks. The exporter who exports the goods from other country may not aware of the credentials of the importer. Then to supply the goods or to supply the plant and machinery, he requires guarantee from the bank. That guarantee called letter of credit. Foreign guarantees are called a letter of credit. And bank guarantees within the country boundaries. Letters of credit, foreign guarantees. So the importer, that is corporate debtor, who is availing loans with you, he want to import the goods from other countries. And the exporter of other country, no, I don't supply the stock because whether you are going to pay or not on reaching the stocks, I don't know. But get letter of credit from the bank. Once the bank is issued guarantee on behalf of the corporate debtor to the exporter, then only he will start the supply of either raw material or the plant and machinery. This is the letters of credit is governed under UCPDs, Uniform Customs and Trade Practices for Documentary Credit, that is a brochure 600. So letters of credit is UCPDC, but bank guarantees are governed under contract, Indian Contract Act. So the letter of credit, once the borrower, the exporter pay the amount, they supplied the goods based on the letter of credit, and the borrower not paid, that is corporate debtor not paid the amount to the supplier, then the supplier will submit the letter of credit to the bank. Your particular client is not paid, you please pay the amount. Immediately bank will open the loan account, debit to the loan account of the amount and pay to the supplier. Otherwise, the goodwill of the bank will lost. Because once the guarantee is devolved, immediately banks will pay the amount. So for this letter of credit also, banks are not giving simply the papers, letters of credit to the borrowers or corporate debtors. They will take suitable security. If at all he is want to import 50 crores worth of machinery or raw material, definitely they will ask 50 crores worth of security. The letters of credit governed by the UCPDC, Uniform Customs and Trade Practices for Documented Credit 600 brochure, and bank guarantees are governed by this one, that is Indian Contract Act. But a letter of credit in foreign exchange oriented branches only they will give, not by all branches. Bank guarantees, any branch they can give. So this is the difference between the letters of credit and bank guarantees. Now, issue of bank guarantees. It is within the country. Issue of letter of credit for imports, for importing of raw material, for importing of a machinery, that is also required. Why this is very, very important in a CIRP process means, whenever bank guarantees are there, the margins are available with the bank. You verify that one, how much margin is there by way of a fixed deposit. Or if at all securities are given for bank guarantee as well as a letter of credit, how much securities, what type of securities he has offered. That also you take into consideration. And the bank guarantees, if at all devolved, that amount also you have to include in the claims. And the letter of credit is devolved, that amount also you have to include in the claims. And accordingly, the financial, the COC committee, the financial creditor voting rate is also to be fixed. So this is two are very, very important. These are called quasi credits, non-fund based business. It is neither a credit nor this one. It is a quasi credit. Once the event was happened, then only it is called credit. Once he is not paid, then only the guarantee or letter of credit will turn into credit. Till such time, even in bank's balance sheet also, we will mention footnote of the balance sheet. In the normal course of business activity, firm need to raw material on credit against a letter of credit issued by the bank, which is also working capital finance non-fund based limit. The firm need to provide security deposit to get the work order. Bank will provide a guarantee in lieu of deposit. So earlier I told about the government wants 20 lakhs guarantee or 20 crores guarantee, either to deposit 20 crores in the government or by way of a guarantee. This is a letter of credit. This is particularly the seller and buyer. So buyer and seller, they will enter into the contract. And the buyer's bank, they will issue the letter of credit in the name of the advising bank. The advising bank, they will give to the seller. In case the buyer is not paid, the seller will submit the letter of credit to the issuing bank. Issuing bank will pay the amount and there ends the matter. Quasi-paid. In international trade, buyer and sellers are not known each other. They are reside in different place or country. Trust is lacking. Mechanisms are developed to mitigate the risk. One such mechanism is termed as letter of credit. These letter of credit are broken into different types. And letter of credit is allowed to facilitate trade between the buyers and sellers of goods worldwide. So most of the companies today, on account of globalization, world is single market. Any company, they can procure the raw material from any place. If at all it is cheaper, they can procure either machinery or raw material from other countries. For that, LCs. In order to facilitate a trade, letter of credit put into place by the buyer and seller. Buyer is assured getting of goods as per the order and payment is assured to the seller through a bank by way of letter of credit. Simple. If the buyer is not paid, I am ready to pay. That bank is giving guarantee. That is called a letter of credit. Foreign guarantees, particularly in the international trade, letters of credit volumes are increasing because on account of globalization. Cite letter of credit. Once the goods are supplied and if the goods are received in good condition, the buyer will give the acknowledgement to the bank, or first he will pay. If not paid, the bank has to pay the amount. In case of site LC, the funds are transferred to the seller after confirming the documents submitted are in order by the buyer. Use and letter of credit is also there. Some of the sellers, they will give credit. Okay, once you receive the goods, you pay after 30 days. Or once you receive the goods, you pay the amount after 60 days. That is called the use and letter of credit. In case of use and letter of credit, the issuing bank will receive the document and the documents are in complying the terms and accept the drafts and agree to transfer the funds at a later date, that is maturity days. If the letter of credit is offered 30 days, they will pay after 30 days. Buyer is provided with a credit can receive the goods and sell the stock prior to making the payment. Next, in case of bank guarantees, at the request of the applicant firm, the applicant is there, the issuing bank is there, the buyers, the beneficiary is the buyer, the beneficiary is the seller, applicant is the buyer, and the buyer's bank is called issuing bank, and beneficiary bank is called advising bank. In case of a bank guarantee, particularly quasi credit, applicant firm, bank issues a payment of applicant firm fails to fulfill the promise. Suppose in case of bank guarantees, if at all he is not fulfilled, then bank will pay the amount. Take for example, in case of contract, if the contractor not completed the road within 6 months, then whatever the damages loss to the government is there, that is to be paid. Guarantees are financial repayment of loan or performance to cover the loss due to non-performance. Financial guarantees, particularly financial guarantees. Take for example, DPG, deferred payment guarantee. It is a financial guarantee. Every month he has to pay the installment. If not paid, the bank will pay on behalf of the corporate data. Guarantees are used security deposit, bid bonds, etc. Normally, guarantees, the government will ask security deposit. No, I don't have the funds, sir. In that case, you submit one bank guarantee in favor of the government like that. And banks are issued guarantees in favor of the following behalf of state government or central government for a tender and contracts in favor of suppliers and raw material, etc., etc., etc. Today, in the real estate sector, number of guarantees are there. Not only in the real estate sector, even manufacturing sector also, they are procuring the raw material within the country, outside the country. And sometimes the suppliers who supplied the stock, they will ask guarantee from the bank. So the guarantees are like a working capital or term loan. That much demand is there to the bank. But here instantly bank will not park the amount to the concerned person. They will based on the fulfillment of the conditions, then only they will pay the amount. In favor of the suppliers and raw material, etc. Today, the state government or the central government or suppliers of raw material, etc. This is happening. Advantages of a non-fund based business. Bank guarantees and letter of credit reduces the financial risk involved in the business transaction. Actually, it reduces the business and it encourages the seller to expand the business on credit terms across the globe with a minimum risk. And sellers, particularly those who are selling the goods on credit, instead of they blindly believe the buyer, through bank guarantee, they will expand the business also. They will provide the goods across the globe. And non-fund based limits enable the firm to utilize the funds more efficiently as a small percentage of transaction kept as a margin. So for every guarantee or letter of credit, bank will ask out of 100, 25% cash margin, remaining 75% collateral security like that. What is the difference between a letter of credit and bank guarantee? Letter of credit is committed to taken a bank to make the payment to the beneficiary if the conditions are met. Commitment. Bank is giving commitment and letter of credit. Bank guarantee also. Bank is given commitment to honor the payment if the beneficiary in case of not fulfilled. The user merchants involved imports and export of goods, letter of credit. The user contracts bidding the larger projects, particularly road projects, or airport, or special economic zone projects. Particularly real estate people also, they are taking the bank guarantees. And a letter of credit manufacturing and bank guarantee also manufacturing units. Protects both parties in the transaction. The seller is confident. If the buyer is not paid, the bank will pay. That confidence is there to the seller. Protects both parties in the transaction. Here also, the letter of credit ensures the transaction goes ahead, and the bank guarantee reduces the loss of incurred if a transaction does not plan. These are the difference between these two. Various types of letter of credit. Letter of credit, different types are there. You may come across definitely 100%. Because when you are handling the corporates, companies, and import of goods are there, or deferred the import of machinery is there, definitely 100% at the time of insolvency commencement date, some guarantees or some letters of credit, it is available. But being a CEO of the company, you can check with the CFO how many guarantees are there, what type of security is offered by the company to those guarantees, how many letters of credit is there, how for what purpose they have taken the letter of credit, what is the margin money they have paid, what is the collateral security offered by the company. If you get this information, the assets available for auction particular or this is also to be mentioned in the information memoranda for giving the correct information to the prospective resolution applicant. And commercial letter of credit is there, referred as a documentary and export letter of credit. It is a commercial nature. Standby letter of credit like insurance against non-performance. This is another type of letter of credit. Confirmed a letter of credit and a bank owned to the beneficiary on their own country. Whatever the types are there, if the types are clearly mentioned on the letter of credit, if you go to the terms and conditions, or if you ask that a particular CFO, Chief Financial Officer, if it is available, he will tell about this one. Whenever the bank guarantees are given, banks will also give terms and conditions for that bank guarantee also. Under what terms and conditions the bank guarantee is issued? What is the security? What is the margin? If the contract is not fulfilled, immediately we will create loan. All these things are mentioned in the terms and conditions. This is also called arrangement of letter. Back-to-back letter of credit issued by one bank by other. Sometimes the company is unable to provide the goods because the stock is not there. Then based on this letter of credit, they will take another letter of credit in the name of supplier. That is called back-to-back letter of credit. If you see that one, it is very easy to understand. And this is also called revolving letter of credit is also there. What is a revolving letter of credit? So bank will give certain amount, 100 crores. Suppose you take, for example, every 2 months, the company is asking 20 crores, 20 crores. For a year, 120 crores. Every 2 months, their payment is happened. Again, they are coming to the bank and they are asking another letter of credit. For that 1 year operation, 20 crores if they take or 20 crores, bank will give. That validity period is 1 year. Once the earlier bank guarantee is paid, second the limit will be 20 crores. It is as good as a overdraft account. It is as good as that is called a revolving letter of credit. Site letter of credit, as I told earlier. Deferred payment LC. So this is also I covered earlier. Particularly deferred means machinery installment. The machinery installments are to be paid, and the capital, the plant and machinery supplied by the exporter to the corporate debtor, that is imported, and bank is not giving any loan, but the exporter asked for each and every installment, bank has to give guarantee. So that is called a deferred payment guarantee. The deferred payment guarantee to be issued by the bank in favor of the exporter who supplies the machinery, and for the purpose of the installments on behalf of the particular borrower. So that's why, and red clause is there. Irrevocable letter of credit is also there. The red clause is sometimes whenever the company is providing supply of stocks to the other countries, or the company is getting stock from other countries, vice versa. In the red clause, the opening bank of the letter of credit, they will mention for the exporter, the bank can sanction a loan of so and so rupees for procuring the raw material and manufacturing of the goods. So that is called a red clause. That is called a red clause. Because here, why I am giving in detail means definitely this type of transactions, being a IP, you should know what are the various transactions that are happened and going to be happening and going to be happen. All these things you should know. So the red clause letter of credit is there. Irrevocable letter of credit is also there. Assessment. Normally, the LCs, how much LC is required, banks will also having some methodology to arriving the letter of credit. LCs limit assessed based on the annual consumption of raw material to be purchased against LC. The requirement of the consumption of raw material to be assessed, find out the time for receipt of the goods, including transit period. If the material is purchased under the credit, add usance period or credit period procurement. The formula is like this. So if you say one problem, this is the problem. Anyhow, I am going to supply all these things to you also. So here, being an insolvency profession, the calculations and all not required. But in case any the problems are arise and you want to know the details of the guarantee, then these are useful. But prima facie, whatever the letter of credit, whatever the gang guarantees are there, 100% in most of the organizations, that is 80% of the organizations that are filed with NCLT, definitely 100% they might have availed the letter of either letter of credit or bank guarantee. Suppose you take, for example, one bank guarantee given. He is not taken any loan, that is working capital or term loan. But bank guarantee is devolved. He is not constructed. Immediately, bank has paid 20 crores to the state government by creating a loan account. If that loan is not paid, Then the being a financial creditor is having a right to file an application with NCLT based on that guarantee also. So that's why the assessment, all these things is I'm giving only rough idea. And now coming to the financial guarantees. Performance guarantee. These are issued by the guarantee for performance of the contract. Non-performance leads to damages and compensation. Suppose a road construction, they told within 6 months not to perform. Whatever the loss to the government is said, that is to be compensated by the contractor. For that, he requested the bank for guarantee. Bank has given guarantee. Once the contract is not completed, state government definitely they will send back the guarantee application, the guarantee form. We have given issued the guarantee. The contractor is not they completed. So hence the 20 crores to be paid immediately without any second thought, second discussion. Bank created loan and debit the loan account and credit to the government account. But a financial guarantee, sometimes margin money or bid and or security deposits they will ask. For that also, some of the contractors or companies they will take the bank guarantees. That is called financial guarantees. So these are prevalent in most of the cases. Deferred payment guarantee. This is also I discussed about a deferred payment guarantee. Payment usually in the installment which has been deferred or postponed. Suppose one company, they brought one missionary from other country. Actually, bank told I don't give any term loan for this. Then the corporate debtor approached the exporter who is in other country. Sir, if at all you are given credit for a monthly installment or quarterly installment or half yearly installment or yearly installment, I will produce one guarantee. Then the supplier will supply the particular machinery. Based on that, the bank, based on the security given by the borrower, bank will give deferred payment guarantee. So for assessment of deferred guarantee or term loans, both are one and the same. One is a fund-based term loan. Second one is a DPG, is a non-fund-based business. Deferred guarantee is a payment of usually on installments, which has been deferred or postponed. DPG is issued by the banks in case of purchases of capital goods, machinery where the seller offers credit to the buyer and the buyer's bank guarantee to the payments spread over the period of the time to the seller. Sometimes guarantees are to be issued to the customs authorities also. To release the goods for payment, customs may require guarantee for customs for payment of custom duty covering import of raw material. If at all amount is paid, no problem. Otherwise, customs authority they will tell if you give the guarantee for the payment of customs duty, why? Because normally duty drawbacks scheme is the duty drawback scheme. Whenever we are exporting the goods, whatever the duties paid by the exporter, that is reimbursable. But sometimes what is happening is the exporter may not have the payment, they pay the customs duty, then he will produce the bank guarantee. For that also, customs payment of duty. In case later on, if the exporter not paid, then the customs authority directly send the guarantee to the bank. Bank will create the loan and pay the amount. Advance payment guarantees. Particularly the once this advance is paid, then only I will supply the stock. No, sir, I don't have the fund. Then you take the particular guarantee from the bank and give it to me. The supplier will take the guarantee and supply the goods. If the buyer is not paid, the supplier will submit the bank guarantee to the bank and bank will pay the amount by creating a loan account for that amount on behalf of the the corporate data and pay the amount to the supplier. Shipping guarantee. This type of guarantee issued by the shipping company to release the goods on the basis of bank guarantee in case of non-receipt of title goods pertaining to. Sometimes goods are reached to the destination. Goods are reached to the destination. Destination because I have imported some goods from the other countries, and the goods, particularly the bill of lading and the other documents are not received by me. If at all I continue the goods in the particular port, PO port, then lot of demurrages will happen. Demurrages some ports on hourly basis also, because they will put all these goods in stores. For that they will recover the demurrages. So instead of that, the documents, once the documents are submitted, then only the port authorities will ask the guarantee from the bank. Then only we will release the goods. So the once the particular this one is not submitted, the loss, whatever the loss incurred by the port authorities, that will be recovered from the corporate data. For that, corporate data will take one guarantee and give it to them. Once the invoices are received, he will submit all the documents to the port authority. In case non-submitted, the port authorities directly send the document to the particular bank for payment. So here, what I told is, this type of transactions are more simply operational creditor, financial creditor means financial creditor means what type of loan? What type of loan? All these things we have to know. So, otherwise, later on, it may create some problems also. Whatever it is there, we have to whatever, whether it is particularly bank guarantees or letters of credit or working capital loans, all should be known. Some rough ideas or some fair idea is required. Otherwise, how you will give the direction to the particular staff members or others, or in case of prospective resolution applicant, whenever the prospective resolution applicant want to interact with you, and he is having some doubts in the information memoranda, he is asked any bank guarantees are there or letters of credit is there. What is the bank guarantee? If at all you are raising the question to the prospective resolution applicant, then it should not nice. It should not nice. So we should know into. Then what is a financial creditor? What is a term loan? What is the installments? And what security the company has given. I want to take that company, okay. Then the loan to be repaid in how many installments? If at all you are not having that idea, what reply you will give? Then it shows some, it is not nice in my opinion. So that's why this case is originated based on the failure of the loans or fund or non-fund based business availed by the corporate data from the financial institution. If that is not happened, particularly not happened, then you should know why he has taken, for what purpose, what is the bank guarantees, how many he has taken, for what purpose, what is the margin he has paid cash, what is the collateral securities offered, how many are devolved. All these things are to be known by the insolvency professionals. Simply bonds easy, debentures easy, fixed deposit easy, home buyers easy, or class in creditor or class of creditor. At the same time, financial institutions, operational creditor also easy. Then he will submit the claim. Sir, I have submitted the stock. I have provided the stock to the company. Stock company has given a bill of exchange. This is the invoice. this is a transport document. So I have submitted a claim. You have to verify. Even the claims also, whenever the financial creditors are submitted, your responsibility is to whether the claim is genuine or not. If at all they have submitted one claim, bank guarantee devolved. If at all I am not having the idea of a bank guarantee, if the claim is rejected, then it is not looks nice. That's why these classes were arranged by the ICSI. Because the cases are originated from the banks only, financial institutions only. What are the various products, for what purpose they are giving, whenever they are giving that loans, what type of documents they will take, and what type of securities they are taking, all these things are there. So at this point, I will stop, and tomorrow, 2 to 5, I will continue. Is it okay, sir?
Yes, sir.
Okay, thank you. So now I am stopping, sir, and tomorrow we will meet. Tomorrow we will meet at the 2 o'clock and 2 to 5 o'clock, sir.
Thank you,
Okay,
sir.
thank you. Thank you very
We are
much.
truly grateful for your presence, sir, and look forward to learn from your insights on optimizing in CRIP and PPIRP process through a deeper understanding of bank credits and mechanism. Thank you once again for being with us.
Sir?
Okay, sir.
Okay, thank you. Good night to all.